The thing about labor force participation is a very simple calculation. You say how many people are working, that's the numerator, and how big is the labor force, that's the denominator. That's all it is. Now, it's never 100%, right? Because there are students and homemakers and retirees and others. There are good reasons for some people not to be in the workforce at any given time. But as recently as 2000, that number was 70%. What drove it between about approximately 1975 and 2000 was basically women entering the workforce, women who had been home, as homemakers or performing other roles, entered the workforce, and then that number went up. So like I said, it's never 100, but 70 was very strong. 62 is down a lot. I mean, that's about a 14% decline. Look, GDP, the standard definition is, it's consumption plus investment plus net exports plus, government expenditure, like a 4-part thing. Yeah, but there's a simpler way to do it, which is how many people are working, how productive are, who's working and how productive are they? That equals nominal GDP. And if you have fewer people working, the economy is going to shrink unless productivity is going up, which it's not. And so this is one of the major headwinds. Now, you're right, there are some early retirees. There were a lot of people who stayed home, obviously, during COVID, and it's very well studied and clear that working is a habit. It's a good habit, I think, for the most part, but it's like any habit. Once you break it, it's hard to go back. So once you get used to not working or working from home or just staying home, the government was handing out checks, beginning with Trump in, I believe it was June 2020. Everybody got that one was a $1,400 check. And then in December 2020, at the end of the Trump administration, everybody got a $600 check. And Biden comes in February 2021, not to be outdone, he hands out, I think, a $1,600 check. So everybody got a check, like 2 or 3 of them. And a lot of younger people opened accounts on Robinhood and started trading Bitcoin. That didn't work out too well. But a lot of people saved the money. But there were very definite spikes in retail sales coming within 30 days of the checks. Well, that's not surprising. I give people free money, they'll go buy stuff. And that kind of kept the economy going. It wasn't a real boom, but it looked good. But we're not doing that anymore. There's no more checks, technical sense, where you have a huge pool of able-bodied, potential workers, but a shortage of willing workers because you can't pay a clearing wage. But that's more a reflection of how stressed businesses and how low margins are. And then you look at the big names. I mean, I guess Twitter is the most recent, but Amazon, FedEx, Target, they're all looking at big layoff announcements coming every day. So none of which is good for the U.S. economy. But the Fed looks at unemployment. I mean, I look at it because you're supposed to know what it is. I mean, I always say, if you're trying to forecast the Fed, you got to look at the world the way they do, even if it's messed up. Like, even if they're looking at the wrong things, which they are, as an analyst, you have to look at them to figure out what they're doing. That's how you do intelligence work. Think like the other guy. But then once I take my Fed hat off and say, well, what do I think? The unemployment rate's almost irrelevant. First, that's a lagging indicator. Secondly, it ignores what we talked about with labor force participation. There is no Phillips curve. I mean, you can draw one. Last time I saw a Phillips curve was flat. Well, where I went to school, curves weren't flat. But that's but they're just looking at the wrong indicators. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen, and that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one, because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins. So the dual mandate is price stability and low unemployment. Okay. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from I think it's at 3.5, 3.6 at the moment. If it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever, QE3. Right. So they're willing to do that. And they also think the recession, if it comes, will be mild, but those two things together will get inflation under control. I mean, and what Powell said, he didn't say that their target is core PCE, personal consumption expenditure, price index, core meaning excluding food and energy. And everyone's like, why would you exclude food and energy? Again, I'm not here to debate it. That's what they do. So if you want to think like a Fed head, that's what they do. Okay, they want to get core PCE year over year to 2%. It just came in at 5.2, which was up from August. So September was 5.2. August was about 4.7, give or take. Pardon me. It just went up. I mean, it's not going down. But they're trying to get it down. Now Powell did not say we're going to raise rates until core PC is 2%. He didn't say that. What he said was we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. Mm-hmm. At which point we the Fed will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year.
Right.
So you're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, so they've got to get rates high enough. So they're going to go, 75 basis points in November. December, who knows? We'll know closer to the date. It'll either be 50 or 75. Some talk about 50, but it doesn't matter. I mean, it's going up. Probably going to go up. I have the calendar for 2023. There's a meeting February 1st and another one in late March, I think March 22nd. They'll probably raise at both of those. They're going to get rates up to five-ish. At that point, they probably will have achieved the goal of bringing core PCE down, but they will also have destroyed the economy in the process. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield of maturity below what the Fed will give you for a phone call. I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff.
Right.
So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? Because everyone says, well, yeah, COVID messed it up and the war in Ukraine messed it up. Well, that's true, but it didn't start there. This started in 2018 with Trump's tariffs. Because I'm not here to debate the tariffs. I actually think the tariffs were a good idea, but that was the start of the supply chain breakdown. Because when Trump put tariffs on, started with appliances, washing machines, refrigerators and stuff, and then solar panels, and then, technology, and then they just kept piling on. But you have to look at what China did in response. The U.S. and Brazil are the two largest exporters of soybeans. China is the world's largest importer of soybeans. Mm-hmm. China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the U.S. to keep the U.S.-China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil. Stop buying U.S. soybeans. Well, that's not a phone call. I mean, you're talking about vessels, port facilities, agriculture, trucks. How do you get the soybeans to the ports? How many do you grow? Where's the fertilizer coming from? Et cetera, et cetera. And all those parties, the shippers, the cargo, the insurance companies, there's so many people involved, banks, letters of credit, it's just a lot involved. They don't like short-term relationships. They say, okay, I'll do it. I want a 5-year contract. And China said, okay. So they reconfigured all those transportation lanes to get the soybeans from Brazil. All of a sudden, you're a U.S. soybean grower. You say, well, what do I do? Well, we started selling them to the Netherlands because the Netherlands needs soybeans too. So now instead of shipping them from like Port of LA to Ningbo and near Shanghai, we're shipping them from Port of Houston to, I don't know, France, or Marseille or someplace, or Rotterdam. So the point being, you completely scrambled all these supply chain relationships in 1991. I talked to the guy who, look, this is a worldwide endeavor, but he was probably the single most responsible individual for all the significant developments in the supply chain in the last 30 years. And he said to me, he said, Jim, you have to understand, it took us 30 years to build it. We blew it up in 3 years. It's not going to come back overnight. It's going to take 10 years or more to rebuild it. Janet Yellen called it friendshoring, and Macron called it a constellation of nations. I use the term a college of nations, collegial club, if you will. So you'll still have trading partners, you'll still have outsourcing, you'll still have transportation lanes, but it'll be members only. It'll be basically democratic, kind of liberal republics, Western Europe, the EU, of course, U.S., Canada, Australia, New Zealand, Japan, and some others. India, we expect to be included. Friendly nations, but China's out. We're decoupling from them. They're decoupling from us. This isn't U.S. driven. The U.S. is participating, but this is what China wants too. Both sides are decoupling as fast as they can. China can develop its own network, maybe Central Asian republics, some Southeast Asian suppliers and so forth, but they're going to lose customers. Well, most of their customers actually in the United States. We won't buy their stuff and we won't sell them our stuff, particularly high-tech stuff. So the world's going to break, and these new clubs are going to be formed, and there will be trade and there will be transportation lanes, but it'll be much more restrictive. Now, will prices be a little higher? Yes, but it'll be more secure. So the way I describe that, if you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down, you hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, the stuff we're seeing coming out of Ukraine, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months. And in the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Here's another, $30,000 or whatever, because people would quit. And that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We don't. This is not what's going on. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, which is, again, what I talk about in the book, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how cost push inflation, tips into a recession, and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, was super whip inflation now, except we had a recession and prices collapsed.